Welcome to our next lecture. Bear put spread strategy is a great strategy to make profit from a price decline of the underlying stock. It consists of one long put with a high strike price and one short put with a lower strike price with the same expiration date. The spread is established for the net debit because the price of long put is always greater than the sold put. The maximum profit is limited if the price falls below the lower strike price and is equal to difference between the strike price minus net cost of the spread. And maximum loss is limited if the stock price rises above the higher strike price and is equal to the cost of the trade. But if we execute the strategy when the underlying stock is in downtrend, we will never incur a loss. If the stock price closes below the lower strike price of sold put, both options expire in the money, but the long put will have higher intrinsic value than sold put, so we get the maximum profit. And if the stock price rises above the long put, then we suffer a maximum loss equal to debit taken when entering the trade. Suppose stock ABC is trading at $50. You are bearish about the stock price as it is in downtrend. So you enter a bear put spread by buying a January 52 put for $3 and selling a 45 put for $1. So the cost of trade is $2 for entering the position. Maximum gain is equal to difference between the strike price minus net debit is equal to 52 minus 45 is equal to 7 minus 2 is equal to $5 per share. And maximum loss is net debit, that is of $2 per share. Lot size is 100. Multiplying by 100 we get maximum profit can be $500 if price declines and maximum loss can be $200 if price rises. If on expiry the price of stock drops, both puts expire in the money with 52 long put having $800 intrinsic value and the 45 sold put having $100 intrinsic value. The spread would then have a net value of $700 deducting the cost of trade when entering the position. So your net profit is $500, that is also a maximum gain. And if stock had rallied to $54 instead, both options expire worthless and you lose the entire debit of $200 and this is also a maximum loss. But we will make our position only when we are sure about the downtrend of the stock, so we will definitely get profit. If we see on this chart, the stock is in uptrend but currently it is in short-term downtrend. So if we zoom in the chart, we can clearly see that the stock is in downtrend, a short-term downtrend, and it is trading near its resistance line. This is the resistance line for the short-term downtrend and this is the support line for the short-term downtrend, and we are expecting a decline up to the level of this support line. It is near its resistance level, so we can adopt the strategy when stock will touch this resistance line. It is near its resistance line but it is not touching this line, so we will not adopt this strategy right here, but we will execute the strategy when stock will touch this line by buying one put of $45 and selling another put of, the support line is near about $36, so we can buy a put option of $45 and we can sell a put option of $36 to execute this strategy. This is another example in which the stock is in downtrend and it is moving in downtrend since 2016. The stock is moving in a channel. We see the range is very wide and the stock is moving in a parallel channel having a resistance line, having a support line. So we can execute the strategy every time when stock touches its resistance line. These are the level where we could adopt the strategy, and now after touching its resistance line the stock is moving in between this range, so we will not adopt this strategy here because the stock is in between the range and it may touch the support line, but we are not very sure about the prices here because we are getting a positive divergence on RSI. So we should adopt this strategy only when we are very sure about the decline of the prices. So we could adopt the strategy only when the stock is near its resistance line. So if the stock is in downtrend, we can surely make money by executing the strategy. Thanks for watching the lecture.